Corporations require expensive machinery, real estate, and vehicles to function, but purchasing these outright drains capital. Leasing allows them to control and extract economic value from these physical assets without taking legal ownership. Historically, companies could hide these massive multi-year commitments from investors. Today, accounting standards require any lease exceeding 12 months to be capitalized and placed directly on the balance sheet. At the commencement date of the lease, the lessee must record two simultaneous entries: a right-of-use asset representing their control of the property, and a lease liability representing their obligation to pay for it. Both of these figures are anchored to the exact same metric. They are calculated as the present value of the future lease payments over the term of the contract. Look at the fundamental accounting equation here. Because the present value of the payments dictates both sides, the initial transaction lands in perfect equilibrium. The right-of-use asset perfectly offsets the lease liability. At the exact moment of signing, whether a contract is categorized as a finance lease or an operating lease, the two look indistinguishable on the balance sheet. The true distinction between these lease types lies strictly in their subsequent measurement and the amortization mechanics applied over time. While the balance sheet begins in perfect harmony, the mechanical rules governing the income statement force their expense profiles to diverge over the life of the lease. Accountants determine which set of rules applies by subjecting every lease contract to a strict classification test. If the contract meets any one of 5 objective criteria, it is categorized as a finance lease. The first criterion checks if the lease transfers full legal ownership of the underlying asset to the lessee by the end of the term. The second evaluates purchase options. If the contract includes a bargain purchase option that the lessee is reasonably certain to exercise, the threshold is met. The third examines time. If the lease term consumes the major part of the asset's remaining economic life, generally defined as 75% or more, it triggers the finance classification. The fourth focuses on present value. We sum the present value of the lease payments plus any guaranteed residual value. If this equals 90% or more of the asset's fair value, the lease is classified as a finance lease. Finally, the fifth criterion checks if the leased asset is so specialized that it is expected to have no alternative use to the lessor once the term expires. If a contract fails to meet any of these 5 thresholds, it is automatically categorized as an operating lease. Meeting any of these 5 criteria signifies that the lessee has assumed the economic risks and rewards of ownership. We can observe how this classification translates into balance sheet values by analyzing a specific contract from a hypothetical company, Cottle Inc. Look at example 4-2. Cottle enters a 3-year lease with annual payments of $100,000. Crucially, the contract includes a $15,000 purchase option that Cottle is reasonably certain to exercise. This satisfies the second classification criterion. Notice the discount rates provided here. Accounting standards dictate a strict hierarchy. A lessee must use the rate implicit in the lease, here 10%, because it is known to them, rather than relying on their own 15% incremental borrowing rate. To calculate the present value of the lease payments, we combine the annual rental payments and the exercise price of that $15,000 purchase option. The present value calculation yields exactly $259,955. This precise number becomes the recognized starting value for both the right-of-use asset and the lease liability. Look at example 4-3 for an alternate scenario. Cottle signs an operating lease with no purchase option, and the rate implicit in the lease is unknown. Without the implicit rate, Cottle must use its 15% incremental borrowing rate. This yields a calculation of $267,774. Because no initial direct costs were incurred, the right-of-use asset perfectly matches this new liability. Despite relying on different inputs and different discount rates, the fundamental mechanical entry at day 1 remains structurally identical. Assets and liabilities scale in exact lockstep. The divergence between these two accounting methods occurs entirely on the income statement, driven by how subsequent periodic payments are treated. Every periodic lease payment made by a company is split into 2 components: the interest expense on the liability and the reduction of the liability's principal. This schedule models the subsequent measurement of a finance lease on the left. Notice how the calculation for interest expense is kept completely separate from the amortization of the right-of-use asset. The interest is calculated using the effective interest method, multiplying the beginning liability by the discount rate. Because the principal shrinks with each payment, the interest expense is highest in year 1 and steadily declines. Simultaneously, the right-of-use asset is amortized on a straight-line basis over its useful life. This layers a heavy fixed expense on top of that declining interest curve. Shifting focus to the operating lease on the right, the rules change entirely. Accounting standards mandate a single, mathematically smoothed periodic lease expense. This single expense is calculated by taking the total undiscounted lease payments and dividing them strictly by the lease term in years. But the liability still accrues interest via the effective interest method. To keep the total periodic expense perfectly flat, the amortization of the asset acts as a mathematical plug. It artificially fluctuates, increasing each period by the exact amount the interest expense decreases. Finance leases inherently drag heavily on early year earnings by stacking two separate expenses. Operating leases use the asset amortization as a buffer to protect the income statement from that early year volatility. This graph maps the cumulative expense profile. The finance lease slopes steadily downward. The operating lease holds perfectly horizontal. Despite these divergent income statement profiles, total lifetime cash outflow is the same. Both liabilities zero out at the precise same endpoint. Because the expense timing differs so drastically, strict presentation mandates are enforced on the balance sheet, so investors can accurately assess a company's financial health. Finance lease liabilities and operating lease liabilities, as well as their respective right-of-use assets, must be clearly separated and never commingled into the same line items. There is one remaining caveat in this regulatory framework allowing for off-balance sheet financing. Look at this specific exception. This is the short-term lease exception. It applies strictly to contracts with a term of 12 months or less that do not contain a purchase option the lessee is reasonably certain to exercise. Under this boundary, the lessee bypasses the capitalization mandate entirely. They record their payments as a simple straight-line rent expense, leaving zero footprint on the balance sheet. Modern accounting quarantined off-balance sheet financing to a strict 12-month window, forcing all true long-term corporate commitments squarely onto the balance sheet.